Difference between standard and limited risk accounts. Due to the leverage, financial spread betting can be a high-risk activity. You can create large gains, but you can also create large losses. This video looks at the differences between standard and limited risk spread betting accounts and how you can manage your maximum loss. Margin. Before we compare these two types of accounts, we need to look at the concept of margin. Whenever you want to place a spread bet, the spread betting company will only allow you to do so if you have sufficient capital in your account to protect against any likely loss. If, for example, we were buying shares for investment purposes using a standard share dealing broker, we would have to deposit the full value of the instrument that we were buying. In spread betting, we do not own the underlying instrument. Instead, we are betting on its future price. As a result, we typically only need to deposit a small fraction of the cost of the underlying instrument as margin, typically between 5 to 20%. Standard risk accounts. In a standard risk spread betting account, when we want to place a new bet, the spread betting company will ensure that we have enough capital in our account to cover the margin requirement. If, for example, we would go long on a stock that is valued at 724 pence at £1 a point, equivalent to the £724 holding, and there is a 10% margin requirement on that instrument, we would need to have £72.40 in our account as margin to open that bet. That £72.40 would then not be available as margin for any other bets. In a standard risk account, you may or may not be required to place a stop loss on your trades. This varies from one spread betting company to another. Let's say that in our 724 pence long trade example, we place a stop loss at 654 pence. If we are stopped out, we stand to lose £70, which is less than our initial margin. However, the market could get down through our stop and open anywhere. Let's imagine that some particularly bad news comes to light about this company overnight whilst we are in our trade and the stock opens at 602 pence. The following morning, our stop loss is triggered and we lose £122. We only had to have £72.40 in our account for that trade, but we have lost £122. With standard risk accounts, it is possible to lose more than the value of your account. The spread betting company will then be ringing you to deposit further funds to cover your losses. Limited risk accounts. In a limited risk account, you are forced to place guaranteed stop losses on all your trades. Your margin requirements will then reflect your maximum loss, and you can never lose more than you expect. With a limited risk account, you will never have the spread betting company calling you to deposit more funds. Guaranteed stop losses come with a small premium, which usually amounts to a few points on each trade. Note that not all spread betting companies offer guaranteed stop losses or limited risk accounts. When they are offered, guaranteed stop losses can usually also be used in standard risk accounts. The major difference between the two accounts is that guaranteed stop losses must be used with limited risk accounts. Parting note. If you are just starting out in financial spread betting, then a prudent course of action may be to open a limited risk account. Many of the spread betting companies will offer this account facility, and as a new spread bettor, they will be only too glad to assist. You know that with a limited risk account you are never going to experience a margin call, and you are safe in the knowledge that you will never need to supply more capital into your trading account.